Hello, everyone. Welcome to the first video of Chapter 5. In my time teaching this course, I find that the chapter that students struggle the most with is Chapter 5. Um, and I am dedicated to trying to get that fixed or improved because at its core, Chapter 5 is about learning a specific calculation. The calculation can be modified somewhat depending on which class we're dealing with, but it's really just a calculation. So this first video, we're not going to go through slides or exercises. This is sort of a short primer. I'm just going to kind of show you the calculation that we're going to work through. I'm going to explain its parts as fast as I can. If you don't get it right away, that's fine, because the future videos in this chapter, we will go through them slowly and we'll cover those points. But I just want to have this primer at the forefront of your mind to see that we're really just explaining how to do this here calculation. So let's show the calculation. So chapter 5 it's called Capital Cost Allowance, or CCA. Capital cost allowance is the tax version of amortization. In accounting, when you buy an asset, it's very expensive and it's going to last a number of years. So you're going to amortize a certain amount each year. That's the amount that you're able to expense from its original cost. The thing about amortization is the amount that's expensed in a given year is heavily reliant on management assumptions and decisions. The lifespan of the asset, the production quantity, what is considered the useful life. These items all sort of determine the amount of amortization that's going to occur in a given year. So the same asset or the same type of machine, let's say, will in different companies have a different expense amount related to it. Now, the CRA is not interested in auditing every management assumption, so they use what's called capital cost allowance, CCA. Capital cost is the original cost for a given asset. Here's your capital cost. The allowance is how much are you allowed to expense in a given year. In the same way that amortization is expensing a portion of an asset's cost, capital cost allowance is how much of that cost can I expense, the expense portion of original cost. So this formula goes from here. The UCC, we often refer to the UCC, that is the undepreciated capital cost. It's how much of the cost is left to be expensed. We will then multiply it by what's called a CCA rate. Every class or every type of asset has a class it can be put into, and the classes have their set amortization rate. So class A is sort of general equipment. They use 20%. Class 1 is buildings. They amortize at a slower rate because they last longer, so it's 4%. Class 10 is automotive equipment, or pretty much any equipment that has an engine. That's 30%. So the CCA rate determines how much of our UCC we can expense in a given year. So if we have a UCC of 30,000, we can expense or deduct 20% of it in a year. 20% of 30,000 is $6,000. So we just take this number times 20% times this 100% times 1 times 100% is 6,000. I'll get to these columns so far, but right now they're not affecting the calculation. 100% of any number is just that number. So 30,000 times 20%, we can expense $6,000 this year. That's the basic calculation. I think where students get thrown off are these two columns, the half year and the accelerated incentive. These columns come up when you have new assets in a given year. New assets weren't purchased at the first day of the year. They were purchased sometime from the beginning to end. So on average, the CRA expects that an asset was purchased about halfway through the year. One company might have purchased an asset early, another company purchased it later. On average, the equipment exists for half a year. So When we take 30,000 times 20%, the half year rule says we should only take half of the CCA in that year. So that CCA claim is $3,000 instead of the six. So if we had $30,000 of undepreciated capital cost from previous year, this year we buy another machine worth $30,000. The original UCC, we're expensing 6,000 of it. Of the new additions, we're expensing 3,000. So in the year, we will deduct $9,000. Our UCC plus our additions combined is $60,000, right? Our original cost plus our new cost. When we combine them at $60,000, we're deducting $9,000 in expenses. So that leaves $51,000 yet to be depreciated. So that 51 comes back up and fills that slot next year. Coming back to the half-year rule, when it applies, I think students are unsure because right now the accelerated incentive is in place. So when the half-year rule applies, the accelerated incentive right now is saying, let's double that. So what it does is it takes our half-year rule times 2, and that just brings our CCA claim back where it was, right? So whether we had $30,000 in the beginning or $30,000 in net addition, these two things are kind of undoing each other. So it's almost like we can just ignore those two columns. This confuses the heck out of students right now. When does the half year rule apply? When does accelerated incentive? Accelerated incentive right now applies almost any time the half year rule applies. Instead of trying to guess when does and when doesn't it, I will simply tell you which class is still affected. And right now that class is class 53. So we will have a video where I will explicitly talk about class 53 and how it's different. For every other class, you can kind of ignore the half year rule. I still need to teach you the half year rule because this accelerated incentive goes away after 2027. So in a couple years, that's going to go back to 1. The half year rule will continue to apply. I think this is what's tripping students up. So lucky for you guys, right now, this calculation's the easiest it has ever been because you can almost ignore those rules for the purpose of calculation. Hopefully that was clear. If you have any questions, please email me, let me know. I'm willing to re-record this primer. If it's not as clear as I hoped it was, we can refresh it. This is sort of an addition to my usual teaching. I came up with it in the summer. I'm hoping that as we go through the slides, as we go through the course material, keep coming back to this calculation and to help you understand how these parts are affecting the overall numbers. Okay? Other than that, thank you for your time. I will see you in the next video where we will start talking about capital cost allowance.